China has just instructed its major banks to limit their exposure to U.S. Treasuries. No formal press conference, no dramatic announcement, no official decree broadcast to the world. Just quiet guidance behind closed doors. And in global finance, quiet guidance often matters more than loud statements. So what actually happened? Chinese regulators reportedly advised banks to reduce or slow down purchases of U.S. government bonds. If a bank is already heavily exposed, it's being encouraged to gradually trim those positions. Not dump them. Not panic. Not stage a financial attack. Gradually reduce. The official explanation? Concentration risk and market volatility. In plain English, that means this. Don't keep too much money tied up in one asset class, especially one that's been swinging aggressively in price. And regulators were careful to frame this as risk management, not geopolitics. They made it clear this is not a declaration of lost faith in U.S. creditworthiness. They also clarified that this guidance does not apply to China's official state-held Treasury reserves. That distinction matters. China as a sovereign state and Chinese commercial banks are not the same thing. The central bank needs liquid dollar assets. It needs them for currency stabilization, foreign exchange management, and financial system support. Commercial banks, however, operate under different pressures. Their balance sheets are exposed to mark-to-market swings. When bond prices fall sharply, those losses show up quickly. And in today's environment, volatility is not theoretical. It's everywhere. Now here's where markets paid attention. As soon as this news circulated, Treasury prices softened. Yields edged higher. The dollar weakened slightly. That reaction tells you something important. Global investors are hypersensitive right now to any signal involving foreign demand for U.S. debt, especially when that signal comes from China. But let's put numbers around this. As of the latest available data, Chinese banks held roughly $298 billion in dollar-denominated bonds. That figure includes various instruments, not exclusively treasuries. China's total treasury holdings, state and private combined, were approximately $683 billion. That's the lowest level since 2008, and it's nearly half of what China held at its peak in 2013. That reduction didn't happen overnight. It's been unfolding gradually for over a decade. China used to be the largest foreign holder of U.S. debt. That changed years ago. Japan overtook China in 2019. The United Kingdom surpassed China more recently. So when headlines say China cutting treasuries, it sounds dramatic. But the reality is slower and more structural. This isn't a shock event. It's part of a long trend. And that's where the real story lives. Because this move isn't just about China. It's about a broader shift in how global investors are thinking about U.S. fiscal stability. U.S. deficits are historically large. Debt issuance continues at an aggressive pace. Political uncertainty has increased. Policy predictability has decreased. And whether you agree with the policies or not, the perception of unpredictability matters. Markets price stability. Investors crave predictability. When long-term policy direction becomes less clear, risk premiums adjust. European pension funds have already begun trimming U.S. Treasury exposure in some cases. Not because they expect a U.S. default, but because they are reassessing geopolitical and fiscal risk. That's a subtle but important difference. No one serious is arguing the United States is about to default. The concern is about trajectory, direction, policy stability. Now layer on top of that the volatility we've seen glow. Bally. Gold recently experienced one of its most aggressive pullbacks in decades after a major surge. Japan's government bond market saw intense pressure. Currency markets have been swinging more than usual. In that environment, holding large amounts of long-duration U.S. debt becomes more complicated. Long-duration bonds are sensitive to interest rate shifts. When yields rise, bond prices fall. Banks holding those bonds can see unrealized losses quickly. So from a regulatory perspective inside China, advising banks to diversify is not radical. It's defensive. It's balance sheet management. And that's the key point. This isn't a fire sale. This isn't a financial weapon being deployed overnight. If China attempted to aggressively dump treasuries, yields would spike sharply, markets would destabilize, and global financial conditions would tighten immediately. China understands that. The United States understands that. Global markets understand that. A sudden liquidation would damage everyone, including China. So what we're seeing instead is something quieter, but arguably more important, a gradual erosion of unquestioned dominance. For decades, U.S. Treasuries were considered the automatic safe haven. No debate, no hesitation. Now there's still dominance, but there's more discussion, more hedging, more diversification. Countries like India and Brazil have been adjusting their exposure. Central banks globally have been increasing gold reserves over the past several years. Alternative settlement systems are being discussed more openly. The dollar remains dominant. Treasuries remain central to the global system. But the margin for policy error is shrinking, and the list of investors quietly diversifying is growing. That doesn't mean collapse. It doesn't mean panic. It means evolution. Financial systems don't shift overnight. They shift gradually. Small decisions accumulate. Policy signals compound. Diversification becomes habit, and over time, structures change. Right now, we are in a period where the global system still runs through the dollar, but the conversation around alternatives is louder than it has been in decades. China's guidance to its banks fits into that larger context. It's not the beginning of something dramatic. It's another brick in a wall that has been slowly building for years. And that's why this matters more than the headline suggests. Because big changes in finance rarely begin with explosions. They begin with quiet adjustments. This is Ryker Dean. If you found this breakdown helpful, make sure you're subscribed. We focus on structure, not noise. And in times like these, structure matters more than ever. Take care.